Two business owners, same industry, same $200,000 in profit. One hands the government about $28,000 in self-employment tax. The other hands over $12,000. Same work, same money. The only difference is 3 letters on a form one of them filed and the other one did not. $16,000 a year. Run that for 10 years and it's $160,000. And if you're building a company you plan to sell one day, that same 3-letter choice can be worth $15 million. See, most owners made this decision in about 10 minutes on a website with no idea what they were choosing. I'm a licensed certified public accountant, and restructuring this for business owners is one of the most profitable things we do. So I'm going to break down all 3, LLC, S Corp, C Corp, in plain English with real numbers. And I'm going to give you the honest version of the C Corp because almost every video on this topic weighs it off in one sentence. And for a specific kind of business, that sentence is costing people millions. So stay tuned to the end for that very part. Let's start with the one almost everybody else has. So here's the thing that surprises most people about LLC. An LLC is not a tax status at all. It's just a legal wrapper. It protects your personal assets if the business gets sued. That's its job. And it does that job really well. But for taxes, the IRS looks straight through a single owner LLC like it's not there. So the technical term is called disregarded entity, which means you're taxed exactly like a sole proprietor. So every dollar of profit hits self-employment tax, which is 50.3%. That's before income tax even starts. So on a $200,000 of profit, that's roughly $24,000 in self-employment tax alone. The good news is you do get a QBI deduction, which is up to 20% of business income. And that is now permanent under the new tax law. So the LLC is a fine starting point. You get protection, simplicity, low cost. It's just not doing anything for you for tax by itself. And one warning while we're here, because people get this wrong constantly. That protection only holds if you treat the LLC like a real separate company, separate bank account, an operating agreement, even if you're the only owner. No running personal expenses through the business. Do the opposite and a court can pierce right through it. And then you have the costs of an LLC with none of the protection. Now, the S Corp. And remember, this usually is not a new company. It's the same LLC with an election filed. Here's what that election changes. Your money splits into 2 buckets. Bucket 1 is a salary you pay yourself. That gets payroll tax. Bucket 2 is a distribution that does not get a payroll tax. Back to our $200,000 owner. So you pay yourself a defensible salary of $80,000. And payroll tax applies to that $80,000 instead of the full $200,000. The other $120,000 comes out as a distribution and skips the 15.3% entirely. That's roughly $16,000 a year from one form you filed. So 2 honest catches. 1, the salary has to be reasonable. There's no magic percentage. It has to be what the job you do is actually worth. And paying yourself almost nothing is the fastest way to get flagged. All right. So 2, it costs money to run. You got payroll services, a separate business return, call it a couple $1,000s a year, which is why below roughly $50,000 to $60,000 in profit, the savings often get eaten by the cost. So the S Corp is the answer for most profitable small businesses. Most, not all. Now, the one everybody tells you to avoid, a C Corp, is a completely separate taxpayer. It files its own tax return and pays its own tax at a flat 21%. And here's the objection you've heard 100 times. Double taxation. It's real. The company pays 21% on its profit. Then, if it pays you a dividend, you pay tax again personally on that same money. So on paper, money you pull out of a C Corp can get taxed roughly twice. And that's why most advisors stop right there and say, do not do it. So for most business owners, that advice is rock solid. If you need to take all the profit out every year to live on it, a C Corp is usually the wrong answer for you. But there are two things a C Corp does that the others do not. First, it lets you leave money inside the business at 21%. So if you're a high earner personally, your top rate is 37% plus state. So profit you do not need to touch. Money you're going to reinvest into inventory, equipment, into hiring sits inside the C Corp taxed at 21% instead of coming to you at 37% or more. So for a business that's growing fast and reinvesting hard, that difference compounds every single year. Second, fringe benefits. See, a C Corp can deduct things for owner employees that an S Corp genuinely struggles with, including certain health and benefit arrangements. But notice the condition hiding in the double taxation objection. If you take the money out, that's where the honest version starts. So here's what almost nobody explains in a comparison video. If you are building a company you intend to sell one day, the C Corp can be worth more than every other tax strategy in this video combined. The reason is because of a provision called Qualified Small Business Stock, QSBS. And here's what it does. If you own stock in a qualifying C corporation and you hold it long enough, you can sell it and exclude the gain from federal tax. Not defer it, exclude it. And under the new law, for stocks issued after July 4th of 2025, it works on a schedule. You hold it for 3 years, half the gain is excluded. 4 years, 3/4. 5 years or more, 100%. And the cap went up, $15 million per person, or 10 times what you put in, whichever one is bigger. Listen to me again. $15 million of gain federally tax-free on a business sale. That is only available on C corporation stock. An LLC cannot do it. An S Corp cannot do it. So the real comparison isn't 21% versus a distribution. It's saving $16,000 a year as an S Corp against potentially millions at the exit as a C Corp. Now the honest limits, because this is not for everybody. Your company has to stay under $75 million in asset when the stock is issued. So service businesses like law, accounting, consulting, and health are largely excluded. And if you sell before 3 years, you get nothing. So if you run an agency or a practice and you take the profits home every year, stay where you are. But if you're building something with the real enterprise value that you plan to sell, this deserves a serious conversation before you pick. Let me make this simple. If you're just starting out or your profit is still roughly under $50,000, stay a LLC. Keep the protection, keep the simplicity. Once you're consistently profitable and taking money home, elect the S Corp. That's most business owners watching this, and it's the single highest return form you'll ever file. If you're building a company to sell, raising outside investments, or you can leave profits in the business to grow, get a real analysis on the C Corp before you default away from it. And here's the thing nobody tells you. This is not permanent. Businesses change structure as they grow. The right answer at $50,000 in profit is not the right answer at $500,000. The mistake isn't picking the wrong one at the start. It's picking one and never looking at it again. Let me show you what that actually looks like over time. Say year one, you start consulting. $30,000 in profit. LLC, that's correct. Year three, you're at $140,000 and taking it home. You elect S Corp and save around $15,000 a year. Correct. Year six, you've built a software product with real enterprise value. You're reinvesting most of the profit and a buyer is sniffing around. Now, a C Corp conversation is worth having, and it may be worth millions at exit. Same person, same business. 3 different right answers. And here's one practical thing that costs people a full year. The S Corp election generally has to be filed within about 2.5 months of the start of the tax year to apply for that whole year. You miss it, and in most cases, you're waiting until next year. Every spring, I talk to business owners who would have saved $15,000 or $20,000 in taxes if they'd filed one form in February. That's it. One form, one deadline, 5 figures saved. Here's what matters most. Your entity is not paperwork. It's the container everything else runs through. I'm talking your salary, your retirement, contributions, your deductions, and what you keep when you eventually sell. Get it wrong and you overpay every year, quietly, forever. So if you're not sure yours is right, or if you've never had anyone actually run the numbers on it, that's exactly what we do at HK Financial Advisory. We look at your profit, your goals, and your exit, and build the structure around them. So book a strategy session with my team. The link is right below. Until then, I'll see you on the next video.